Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, June 26th, 2026. We're recording at 11:30 Eastern Daylight Time. This is episode number 59. I am your host, Scott T. Slayton, Chief Strategist at Capital Creek Partners. Now your starting lineup. Core PCE inflation data, in line for May, but a troubling trend. Number 2, Micron earnings, much more than just an earnings blowout. There are implications across the technology supply chain from this one. And number 3, implications of an inflationary boom. So back to core PCE. Core PCE printed in line at 3.412% versus 3.4% estimates and 3.3% prior in April. Services represented over 82% of the rise in CPCE inflation in May. Durable goods represented only 12% and non-durables represented 5%, but all three are rising, very much unlike 2025. Supercore, or core services less housing, rose 3.9%. That's a big rise, and I think the Fed pays attention to this measure of inflation also. So services make up approximately 80% of U.S. GDP, and the costs of services are inflating too rapidly. Warsh knows that the Fed never got rates high enough to quash services inflation that took off after the pandemic, or they cut too early, and probably both. When we average all the key inflation data for May, we get 3.6%, and that does not include the PPI data. We took the four most basic measures of inflation in the U.S., and we averaged those 3.6%. That's up from 3.4% in April, a troubling trend. So the bottom line is that inflation is trending higher in the U.S. Yes, oil prices are falling, and that is very important. We would not minimize that at all. But semiconductor and memory prices, the new oil, the oil of the new economy, those prices are rising, and in some cases very rapidly. We'll get into that with Micron. So consistent with our punch bowl thesis, we think the next move for the Fed is to raise rates. And therefore, we reiterate our underweight on U.S. fixed income. Now, Micron earnings. Micron reported third quarter 2026 earnings of $25.11 versus the street estimate of $22.50. That's a 23% beat. That's great, but that's not why we're focused on this. Evidence is that the booming memory cycle today is different and much more durable than past cycles. AI demand remains extremely strong, according to management, and supply is still very much constrained. We don't see this AI memory shortage ending anytime soon, nor does Micron management. Here's a key point. Memory is a strategic asset, not a commodity. Those of us that have been around for decades have it in our minds that memory is just a cyclical commodity. We need to unlearn that. It is no longer a commodity. It is a strategic asset. And Micron has moved from a commodity supplier to a strategic infrastructure partner, and that's clear based on all of the long-term contracts they're signing. Memory prices used to be made in the spot market for decades. Now, companies that need memory are signing long-term contracts with escalators. Gross margins for Micron are reaching extraordinary levels. In the third quarter, gross margins of 85%. That's like software. That's better than a lot of software companies. So Micron has extraordinarily strong pricing power. Operating margins of 80%, very strong free cash flow, and management is indicating higher profits in the future. Management raised guidance on this conference call yet again for the fourth quarter, where they project revenues of $50 billion, gross margins of 86%, and earnings of around $31, up from $25 in the third quarter just reported. Here's another key point that the management made. AI inference is becoming the next major driver of memory demand. Inference requires much more memory than training. Record cash generation, despite record capital spending. That's very unusual. I've covered companies for 35 years, and I do not remember seeing a company producing record cash generation despite record capital spending. So memory is the new oil, and it is sold out through 2028. Memo to the Fed. Memory goes into everything from artificial intelligence to consumer electronics to the entire automotive supply chain. This was underscored by Apple this week, saying they are going to raise prices on computers and tablets, in some cases up to 20%. Let that sink in. 20% price increases on some of the most important electronic goods for consumers and enterprises. Now on to the implications of an inflationary boom. We know we're in an inflationary boom, and history says that is not a good combination for financial assets. Financial assets typically, stocks and bonds, typically do not like growth being too strong because it often produces inflation that is too high. And we think that is where we are today. Nominal GDP growth of 6% or higher is where we are today. At the end of the first quarter, nominal growth was 6.1%. You get nominal growth by combining real GDP growth with the inflation rate. And today that is over 6%. We went back and looked at over 30 years of data on Bloomberg, and we discovered that from 1999 through 2019, in the 20 years before the pandemic, nominal growth averaged 4%. Now it's averaging over 6% since the pandemic. So 50% higher nominal growth. And it's been steady. We think this is being driven by a spending supercycle, which has stimulated both growth and inflation. Well, what's underpinning this? We think artificial intelligence and the build-out, the need to rebuild supply chains, the need to reshore manufacturing in the U.S., the need to spend more on defense, the energy transition, fiscal largesse, which is producing 6 to 7% deficits of GDP. Many of these things are going to have to go on for years and will require trillions in spending. So, of course, we have a corporate earnings boom that has resulted from this spending supercycle. And we see no reason why the second quarter should not be just as strong as the first quarter, which means very strong and very impressive. But the cost of capital is going up along with the demand for capital. And we discovered this when we sat and listened to 30 different CEOs of financial services companies at the Morgan Stanley Financial Services Conference 2 weeks ago. So we don't think the bull market for equities is over. We think we're in the midst of a summer correction. But the warning signs are present, and liquidity may be falling. Our liquidity monitor is telling us that liquidity is only in the neutral zone. That's down from the positive expansion zone. And we also know that the Warsh Fed is preparing to remove the punch bowl. To us, that was very clear in his opening comments at the June 17th press conference. 6% nominal growth is just too hot for the Fed. It's like the temperature in the room being 78 or 79. Everyone at the Fed is uncomfortable with that. So we reiterate our neutral strategic rating on the S&P 500 with a 74.20 target. That's basically exactly where we are today. And we think this correction is not over. Probably takes the S&P 500 down to the 7,000 to 7,100 zone. Technically, that's where we think it bottoms. And we probably go up from there. So do the work, endure the fog of Warsh, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.